So we're talking about things that you can still do to reduce your taxes for 2023. 2023 is over. Your tax planning should have been done December 31st, but yes, there are still things we can do. All right.
That's right. So we've got a list of things to talk about today. We're going to talk about IRAs, Roth IRAs, HSAs. We've got SEP IRAs, an individual 401k, which we're going to talk about. Some options if you had a loan from an old 401k, an opportunity zone fund, and then really the difference between tax planning and tax prep. So a lot of ground to cover today, Drew.
Yep, a lot of ground to cover. Let's rock and roll.
All right.
So IRAs, okay. Normally IRAs are not tax deductible, but they can be. And there are times when, if you understand the rules as to when you can do a tax deductible IRA, there are still times when you want to do that. For example, I was just working on a client that they had $154,000 of income. And I noticed that the wife didn't have a 401k at her work. The husband did have a 401k, but because the wife didn't, she could still do a deductible IRA. And that was up to $7,000. Well, all I had to do is, because she was at 154,000, all I had to do was put $4,001 into IRA deductible, drop her below $150,000. And because they were both over the age of 65 in the state of Maryland, just that one maneuver with the state of Maryland saved $2,100 in income taxes, but it also saved an additional 800 some dollars in federal taxes, and it saved an extra $320. All in total, it saved about $4,000 into an IRA, saved about $3,300 in taxes. You say, how could that possibly be true? And the answer is, Leo, that there's all these cliff taxes and phase out tax rules that go into effect. And in the state of Maryland, the cliff vesting for a married couple is typically $150,000. $1, Leo, over 150,000 creates a negative $2,000 in income taxes immediately. Just $1, Leo. One stinking dollar. And so one guy makes 149,999. He pays 2,000 less than the guy that made 150,001. It doesn't even make sense. And when I'm talking about your what that income is, I'm talking about your federal adjusted gross income. So you have to understand the principles that can drop you below those, and if you qualify for any of them. This is not something that TurboTax can figure out for you. It's something that you have to see on the return and then visualize amongst all the things you're doing. Is there anything we can do to drop this AGI down just a few $1,000s to pick up that state of Maryland tax benefit? But it also affects IRMAA taxes for Medicare Part B. It affects whether you can do a Roth IRA or not. It affects the premium tax credit if you're on the ACA, Affordable Care Act. I mean, you have to understand when a deductible IRA can be of benefit to you. And for most people, I don't think just doing a deductible IRA is the benefit. But anytime I can pick up on these tax credits that we're losing because your income went over some magical number that some politician thought up, it's incredibly beneficial to know that you can do that. And you can do that all the way up to April 15th. So that's the key to it, April 15th. Anyway, one of the things, though, Leo, you need to do for that IRA is you look at your W-2s. And on your W-2s, there's a box there that says, box 13 says retirement plan. If there's an X in there, you follow those lower income rules, 116 and 73. If there's no box X in there for one spouse, but there is for the other, you follow that higher limit of 218. But if both spouses have no X in that box W-2, or if only one worked and there's no X in that retirement plan, then you can both do the IRA contribution. That's what we're looking for. All right.
That's right. And then, like you said, just to note, as long as you have that earned income, you're good to go. You can do the, that's one of the requirements. You said the earned income, or even you said third-party sick pay or taxable alimony. Those can
Those
count.
things can, yeah, and that's something that a lot of people miss also, that let's say I'm still getting a disability payment from my employer. I'm 63 years old. I'm still getting disability. And that's third-party sick pay. Third-party sick pay counts as earned income. And same if I'm a divorced spouse and I'm getting alimony check. If it's a taxable alimony, that alimony also counts for the earned income to do a traditional IRA. We have a question. Do we want to see if those questions? No, income from rentals does not count as earned income. Unfortunately, no. And there are times, you're best not to count it as earned income, because earned income is always subject to Social Security and Medicare. I shouldn't say always, should I, Leo? I should
You
never
got to be
say,
careful with that one, Drew.
because alimony and third-party sick pay aren't subject to Social Security and Medicare. But let's put it this way: the normal type of earned income is going to be subject to Medicare and or Social Security tax, and you don't want to pay Medicare and Social Security tax just to be able to do a IRA or a Roth.
Yep. And you mentioned here too, it's the other benefit of traditional IRAs sometimes is if you're moving to potentially a lower tax state, either in retirement or in a couple of years or so.
Yeah. Now, somebody asked, what's the limit for single person? Again, if you have an X in that W-2 box, it's 73,000. And if you have no X in that W-2 box, it's unlimited. You can make $1 million and still do a traditional IRA contribution.
Yep.
All right.
Yeah,
Next.
those are great questions. So next we've got a Roth IRA. I know this is our bread and butter here, Drew.
Yeah, we love Roth IRAs. Everybody needs a Roth strategy and understand why you can do Roth and how you can either convert to Roth or you can contribute to Roth. Now, the Roth is the reciprocal of the traditional. So whatever you do in the traditional, the opposite happens in a Roth. So in a traditional, I put the money in, I get a tax deduction. In a Roth, I put the money in, I get no tax deduction. But in the traditional, when I take money out, I pay taxes. In the Roth, when I take money out, I don't pay taxes. So it's the opposite of each other. Now, you say, well, how can a Roth help me if I'm trying to lower my 2023 taxes? And the answer is it can't necessarily, but the benefits long-term are tremendous. There is one exception. The one exception is, let's say you did a Roth contribution in 2023. Okay, you said, oh, I'm going to do the Roth because I always do Roth and I like Roth and I'm not, never going to do a traditional IRA. And then you get and you do your taxes, and then either you pick up on it or you send it to us to review. And everybody out there listening should always send their tax returns to us to review. If we don't do them for you, you should always at least have us review them, because that's part of the service we provide to you. You're paying for it, so you might as well have us review it. But we look at your return and we say, wow, I wish you would have done traditional IRA instead of Roth IRA, because look here, your W-2 gives us the right to do Roth, your income's low, et cetera, et cetera. We can do what's called recharacterize a Roth to a traditional IRA. We can, in essence, say, hey, we haven't filed our tax return yet. We don't want to do a Roth. We'd rather do an IRA traditional and take the tax deduction, so we can reverse it and go back to the traditional IRA. And that could be of extreme benefit. So that's why we bring it up. But nonetheless, everybody should be doing a Roth. everybody. If you can and it's beneficial, you should be doing the Roth.
Yep. And to note on that recharacterization there, Drew, it's important to note that's only for contributions, right? Once you do a conversion, those are not eligible for that recharacterization. That's
Yeah,
a one and done.
we used to be able to recharacterize conversions back to the IRA and not pay taxes on them, but that was done away with in that 2017 Tax Act. It's unfortunate that it was done away with because it was an incredibly beneficial, but this is only on recharacterization of a Roth contribution. You're absolutely correct, Leo. And again, you have to have earned income to do a Roth. The limits are a lot higher. For a single person, it's 138, and for a married couple, it's 218. And those numbers are skyrocketing next year. A married couple is going to like 238, and a single's going to like 145. What is it? What something like that. I think it's 145. So
Yeah,
it's
that's you talk about one of the benefits of inflation is that these income limits increase year over year, which is good.
absolutely.
Yep.
All right, what's next?
All right. Well, next we've got HSAs.
HSA. So now on the HSA, what you're looking for is on your now there's two different ways you could have an HSA. You could be retired but below the age of 65 and not on Medicare. You can never have a health savings account if you're on Medicare. So the minute you're on Medicare, you're not on a health savings account. All right. But you can, if you're no longer working, you can still have a health savings account as long as your medical insurance policy is a high deductible health plan with a qualified health savings account. So you need to look for that. And if you're under 65 and you've got medical insurance, you want to see, do I have a high deductible health plan that is HSA qualified? So again, you don't need to have earned income. You just need to have a HDHP, as we call it, with a qualifying HSA. All right. Now, a lot of times people have that, but they have it through their employer. And their employer allows them to contribute via their paycheck into their health savings account. If they do that, there's a code W in box 12. So just some common codes that you'll see in your box 12 of your W-2. That's what we mean by box 12 code. It's your W-2. Code D in box 12 means the amount of money you put in your 401k. Code AA means the amount of money you put into your Roth 401k. Code E is for a 403B. Code BB is for a Roth 403B. Code DD is for the premium that was paid on your behalf to the medical insurance company. President Obama passed that code DD, there's no benefit to it. Nobody needs to know what the premium is. But President Obama required it to be on your W-2 so that the government could pick up that data as to how much premium is being paid for you by your employers, so that someday, this is my theory, and I'm fairly confident of this, so that someday government can figure out how to take over the medical system using a national healthcare system instead of a private pay. That's my theory as to why that code DD is there, but that's another story. Code W, though, is for the HSA. So let's say I'm doing a tax return, and again, married couple, they have 154,000 of income. They're over that 150,000, that key mark, because remember, that's a cliff mark, or you're single and you have 102,000 of income. 100,000 for singles, that's your key mark. That's your cliff. You fall over that cliff, it's going to cost you about $1,100 in state of Maryland income taxes, maybe 12. And again, it's $100,001. Boom, you fall over the cliff. you owe Maryland an extra $1,100. It's kind of ridiculous that it works like this, but I got a client, they have a code W on their W-2, and I know the limits for a single person, and I'm always talking about people over 55. If you're under 55, it's $1,000 less. For a single person, it would be 4,740, what is it, 4,350?
So for 2024, it's 4150. Last year was 3850 for 2023 without the extra $1,000.
Yeah, so I'm talking about with the extra 1,000, so it's 4,850, right?
Yep.
So it's 4,850. So I'm looking at that code W, and if I see something lower than 4,850, I say, wow, I could put money into an HSA, drop the adjusted gross income down below that 100,000 single, 150,000 married number. There's a lot of other phase out areas. American Opportunity Credit starts phasing out at $160,000 for a married couple, $80,000 for a single couple. So if you or a single couple, that's pretty good. I like that. A
I like, we
single
should coin
person.
that. Yep.
So if you have little Joni or little Johnny going to college and you're putting out $10,000, $20,000 a year in tuition, you could get a $2,500 tax credit, but it's phased out the minute your income goes over 80,000 single or 120,000, 160,000 married. That's a problem. Code W can allow me to drop my AGI down that I'm either not phased out at all, or that I can minimize that phase out. If I have high income and I've got children, $400,000 starts to phase out the child tax credit, which is, $2,000 per child. You have 3 children, that's $6,000 they're phasing out on you. If you can drop your income down, you can pick a lot of that up. So there's a lot more things out there than just the ones that I've, talked about. But Code W tells me I can still put money in to an HSA, just like an IRA for 2023, if I do it before April 15th. Now, remember, anytime you do this with an IRA or an HSA, you always want to make it very clear that you're contributing for 2023, if that's your objective, to lower your income taxes for 2023. Because if you don't tell them, they're going to list it as 2024. And then if the IRS comes back to you in the future, you might have a real problem to get the custodian to bump that back to a 2023. So you need to make sure you tell them clearly that this is a contribution for 2023. Health savings account is a slam dunk, absolute best account you can have because it's tax-free in, and if you pay medical bills with it, it's tax-free out, and you can keep the HSA as long as you want. There's no use it or lose it. The health savings account is long-term, and even when I'm 65 and I start paying Medicare Part B premiums at a rate of $170 a month, I can take it out of my health savings account 100% tax-free. So you're going to use this health savings account during your lifetime. Trust me on that. You're going to use it.
That's right. And one of the other things we always talk about, Drew, is you can always pay your bills now, or your medical bills now, and then as long as you have the receipts, you can pull the money out of the HSA, down the road. So there's that benefit as well.
That's correct. So what Leo's saying is I get a $1,000 bill for some medical thing that happened or a dental procedure. I could pay with after-tax money now and let that 1,000 sit in that HSA for another year, 2, 3, 4, 5, 6, 7, 8, 9, 10 years. Let it grow because I can invest that money in my HSA. I can put it in stocks and bonds and mutual funds, and then keep all those bills. And the key, Leo, though, with that strategy is you have to stay with the same health savings account that you're currently with. So if I have a health savings account with Health Equity, I can't flip my health savings account over to Fidelity and assume that I can reimburse myself. I got to stay with that Health Equity account if I want to do that. But 10 years down the road, that $1,000 I had in the HSA that I didn't pull out became $6,000. I can then turn around 10 years down the road and say, hey, you know that $1,000 that I didn't reimburse myself for years ago, I'm going to do it now and just take it out tax free. I just have to have the records to prove I never reimbursed myself. What's
Yep.
next?
That's right. Well, next we've got SEP IRA, so a simplified employer pension SEP IRA.
Yeah, so this is for people who have a business of any sort, and it doesn't have to be a big business. We do this a lot. People, clients of ours, might work for Johns Hopkins University or might work, at as a lawyer or whatever. But on the side, somehow or another, they came up with a little situation where people pay them 10, 20, $30,000 to come do expert witness, or maybe they're an engineer and they do some consulting on the side or whatever. You've got a little business, you make an extra $10,000-$20,000 a year. I can put up to 25% of my income into the SEP plan. And I have this one, Leo, I have until October 15th if I file an extension. So I don't have just until April 15th to do this. I can do this all the way up to October 15th if I put my tax return on extension. And let me tell you something. Some people are afraid to death of putting their tax return on extension. Nobody should ever, ever again think twice about putting their return on extension, because the IRS, gets, I think, something in the neighborhood of 40% of all tax returns are sent in on extension. So it's not like the old days where they were actually sitting there wondering why these people's tax returns. That, when I say the old days, I'm talking about the 70s and the 80s, but ever since like 1990, putting your return on extension became a given. You used to have to explain why you were going on extension. In 1990, I think it was, the law was changed that all you have to do is say, I'm extending, and that's all that matters. And millions of people extend now. It's a total negative. There's nothing negative or positive about extending, unless you need the time to extend to do your SEP IRA or whatever the case may be. But this will lower your income. So we see it a lot, Leo. People come in and they work somewhere else and make a couple $100,000 a year, but then they have this consulting gig and they are making $25,000, $30,000 paying taxes on it. We come in, we set up a SEP, and all it takes is a signature or two on a piece of paper, and boom, we put 25% of that $20,000 into the SEP, and we lower the income by, in that situation, would be about $5,000, and that just saved us, $1,800 in state and federal income taxes. So now, if you're a sole proprietor or partner, it's a little more complicated than 25%. It's 25% of your net income after your pension contribution and your half of your self-employment tax. And you look at that and you say, wow, isn't that kind of circular? How do I figure out what 25% of my net income is after my pension contribution until I make my pension contribution? And you basically have to do this algebraic formula, and it comes out to be something in the neighborhood of, I think it's 18.97% of your net income will work out to be 25% of your net income after half the self-employment tax and the pension contribution.
Yep. And as you know, Drew, one thing, the SEP is a really powerful tool, but we want to be careful about that qualified business income deduction, because we don't want to, do this a SEP contribution, but also, hurt us with that QBI deduction on the return.
And that's absolutely correct, Leo, because this is something that's only going to last another 2 years, 2023, 2024, and 2025. And QBI basically says is, let's say I did make $20,000 as consulting income, and Drew, the smart aleck Drew, comes in and says, hey, I got a great strategy. I'm going to set up a SEP for you. I'm going to save you a few $1,000s in taxes. So I put 5,000 of his 25,000 into, or his 20,000 or whatever, into a SEP IRA. What I just did, possibly, and there's a lot of complexities to the qualified business income deduction, but as long as your income's below $400,000, it's probably a given that you're going to get it. But what I probably did is I probably just took 20% or $1,000 of that 5,000 tax-free that would have been tax-free if I didn't do the SEP, and put it into a tax-deferred position to pay taxes on $1,000 that I should have gotten tax-free today. And that's somewhat complicated, but trust me on this one. If you have it, do not just rush out and do a simplified employer pension because you say, I'm going to lower my taxes. You need to understand the ramifications of what qualified business income is. If you don't have any, great. If it doesn't work for you, great, then we do the SEP. But if it does, you don't want to do that SEP unless there's a huge benefit to do it. So you're absolutely right, Leo. That's a key that we have to watch for.
Yep. And, on the SEP here, Drew, we're talking about the employer side, because remember, there's the two sides of the contributions. There's employees, and then there's the employer side. The next
We'll
thing.
learn that in the next slide, won't we?
That's right. You got where I was going. So the I-401k, we're talking about both the employer and the employee portion of contributions, right?
Yes, and note what this is called, individual 401k profit sharing account. So this is a 401k for somebody who has no employees. For example, I work for Johns Hopkins, let's say, and I also do some consulting, and I make $40,000 consulting, okay? Now, at Hopkins has to have a plan that's eligible for all employees. Well, if I'm the only employee in my company, I don't need to worry about all the employees. I only have me. And so there's a unique 401k called an individual 401k. Now, some companies have used the term solo 401k. There's all kinds of terms for this, but it's basically a 401k that's designed for a company that has only one employee, the owner. Now, the one exception to this is if your spouse is also a worker in your company, either as a partner or as an employee, then you can still do an individual 401k. But it has to be no more than just you and your spouse. Now, here's the key to this one, Leo, is in a SEP, you can only put in the employer contribution, which is 25% of the salary, or that complex little 25% of net income after the half of self-employment tax. But with an individual 401k, I can also do the employee contribution. Now, this gets a little more complex, but here's the key to this. An employee can put up to 90% of their earnings into a 401k to a max of $22,500 for 2023, and $7,500 more if they're over 50 years of age, for a total of $30,000. So let's go back to that person who works at Johns Hopkins, and he has a consulting gig that makes $40,000. I could potentially put in $30,000 of employee contributions immediately into that plan, and then put an additional employer contribution of 25% of salary, or that complex formula there, right? Except the only exception is that the employee contribution of what we're saying is 30,000 is for all employers. If I have 3 jobs, I work at Johns Hopkins, I also have a private practice, and I do consulting, and I have a 401k in all 3 enterprises, I can only put in 30,000 of employee contributions, period, amongst all 3 of those entities. Anything more than that would be considered a defaulted contribution it would be considered an ineligible contribution, an excess contribution, and it would be subject to penalty if the IRS found out that I had excess contributed to that 401k or that combination of 401k. It's a tricky one when you leave an employer in June and you've already put in $10,000-15,000 in your other employer, and now you go to your new employer and you put in $20,000 or $25,000, and now all of a sudden you went over the $30,000 limit. You have an excess contribution. You got to be very careful about that. Employee contributions are only it's a 130,000 per year, no matter how many employees, how many employers you work for.
Yep.
The employer contribution, though, is for as many employers. You can do that if you have 15 employers you work for. They can each make contributions well in excess of the $73,000 limit there is for total contributions to any specific profit sharing 401k plan that I'm in. So let's say one company, I put in my employee contribution of 30,000, and then they put 40,000 more in for me as an employer contribution. But then I have my own little consulting gig of 40,000. I also have my own private practice of another $100,000. I can do the 25% more to the consulting gig, and I can do 25% more to my own private practice and not violate anything. It's only that employee one that I have the issue with. So wait, they're asking, can I contribute to both my employer 401k and an individual 401k? And the answer is yes. But again, the employee contribution amount cannot exceed the $30,000 in total between the two. But the employer contribution can be unlimited, whatever the law allows for in each plan. There is no negative impact between what the employer did for me at the one company and what I do in my own individual 401k. So that's the key here. But this is a dramatic way that you can do this all the way up to October 15th also, Leo. You didn't used to be able to. You used to have to do this one before 12/31. But they've just changed the law in the last 2 years. This is now eligible all the way up to October 15th.
Yeah. Yeah. I mean, it's a very powerful tool. And I mean, as you know, I mean, there are some costs involved, but if you can really, save on your taxes and really help yourself long-term, those costs definitely are outweighed there.
Well, this 401k and the individual 401k, I mean, you might have some costs. There's one plan we use, sophisticated plan, for those who have a lot of 401k. I'm sorry, that have a lot of income in their self-employed business. We use a plan that could cost $500 or $250. But for the average person, Leo, we're using a freebie plan from Schwab or Fidelity, and the 5,500 may need to be filed, but normally that 5,500 is a piece of cake to file for an individual 401k. So
that's right.
But you're right, there could be costs involved.
Yep. And then the next thing here, Drew, this is something that is not really as common, but it's a very, very interesting topic here. And that is if you were employed and you had a loan through your 401k, right?
Yeah. So, and I did this once. I've only done it once. Well, no, I'm sorry. I did it twice, actually, now that I think of it. And I did it the first year the law was passed. Matter of fact, the custodian didn't even know that I had the option to do this. I had to educate them on this. But they accepted it. So they figured out, they said, oh, you're right. This is new for this year. So anyway, what it is you took a loan out on your 401k and you changed jobs or you retired or whatever, and you didn't pay the loan back yet. Well, if you don't pay that loan back, you don't have the cash to pay it back at that moment in time or whatever. They're going to default the loan. They're going to send out a 1099-R to you and say, hey, Leo, you didn't pay that loan back. you owe taxes on $25,000 or whatever it is. But the key is that you're going to have a code L in box 7. And it would either say 1L, 2L, or 7L. And what that L means is that there's a defaulted loan here. And what that means is that you have until October 15th of when you file your tax return, if you put the return on extension, to pay that defaulted loan off. And this is critical because typically you only have 60 days from when you take a loan or a distribution from a retirement plan. You normally only have 60 days to pay it off. But in a defaulted loan, you have until October 15th of when you file the tax return. And I had a client that had taken a loan out on their tax return and on their 401k plan, and they changed jobs. They defaulted on the loan. Okay. They defaulted on the loan. And then I went to file their tax return for them. And I said, hey, you have a defaulted loan here. You have until October 15th to pay this back. And I said, with your new employer, you could take a loan out against your new employer and then use that money to pay to do the defaulted loan rollover, and we won't owe taxes. And that's exactly what they did. They took a loan out on their new employer's 401k plan. They took that cash, paid back the old 401k plan, and I'm not the old 401k. They can just put it into an IRA and say to the IRS, hey, I rolled it over before October 15th, and the IRS is fine with that. And I even had it. It was even questioned by the IRS. I had to send all the documentation in, and they came back and said, oh, you're right, not taxable. So this is a cool little strategy if you have that happen.
Yeah. And another cool little strategy that we've got here is the opportunity zone, or sometimes they're called OZ funds. And this is great if you have gains, right, Drew?
Correct. So this one's a little more complicated. So let's say, Leo, in October of 2023, you sold Apple stock and you took a $35,000 gain. And then I go to do your tax return. And fortunately, I did it quickly. I did it before March 31st on the day you sold it. You sold it October 31st. And I did your return on March 5th, so well within 180 days. I could say to you, hey, Leo, if we put that $35,000 gain into an opportunity zone fund, you won't have to pay taxes on this until 2026. So that would be in April of 2027 when you'll pay taxes on that. This could be a very good way to defer it. And if that $35,000 in that opportunity zone fund grows and makes another 35,000, that second 35,000 is 100% tax free. Now, not many people are going to have gains in those last 3 months of the year that you could do this and that you would be able to get that money into the opportunity zone fund for selling a stock, and you did it at the end of the year. I mean, it's very possible, but it's not the likely scenario. Where this is really likely is when the guy comes in and their business, they owned a piece of a engineering firm or an architectural firm or whatever, and the business was bought out, and next thing you know, they come in and they give me a K1, and the K1 says, hey, I sold my business and I have $250,000 of gains that I have to report, or whatever the case may be. I have 180 days from January 1st of 2024 to put money into an opportunity zone fund for somebody who sold a business and getting a K1 in 2024 for 2023. I have all the way up until June of 2024 to get that money into an OZ fund, defer the gain until 2026 tax return, which won't be payable until April of 2027. And any money that I put into that OZ fund will be 100% taxable, assuming the deal makes money. But assuming that we choose wisely and it does make money, anything we make on that will be 100% taxable. So yeah, it's a cool strategy. You don't use it very often. I've used it about 5 or 6 times so far.
Yeah, but definitely if there's a use for it, you can obviously see there's quite a few benefits to it
Absolutely.
for any clients that can use it.
What else do we have?
Well, so, sort of the final topic here is, as we've gone through the webinar here, really noticing the difference between tax planning versus just tax prep.
Yeah, I would say, Leo, that about 95% of all tax returns done are tax preparations. We've structured our company to be tax planners and tax preparers all at the same time. And that's why we have a process that we go through. Most companies go through a process merely to make sure that they get all the information down on the tax return. But our process is to make sure we get everything down on the tax return and make sure that we think out everything that can be done for the return we're doing, which is what we just went over right there. Or what can I do for 2024 that's going to be highly beneficial? Like, for example, you get a client that something happened and they didn't tell us during the course of the year. But when we filed their tax return, we find out that they had very little income because they're basically just living off of Social Security. And I could potentially take IRA money and convert it to Roth and get a tax-free distribution over to the Roth and grow tax-free. Those are things that we want to be planning to do. Or maybe I see situations where they're erratic income and it could cause excess penalties at the end of the year. We want to make sure that we get estimated taxes done with that client in the October, November timeframe every year. There's all kinds of cool little things that you can pick up when you're doing a return, not only for the year before, but also thinking out the next year and saying, well, if I would have been able to look at this before December 31st, what would I have done? And then what else can I do after December 31st? That's what a tax planner does. But like I say it all the time, Leo, you've got 500 returns to do, let's say, as a tax person, and you have 2 months basically to do it. Because when did we get our 1099s this year?
Last week, so it's been about a week.
Right, so it was about February 15th, right?
Correct.
Well, if you can't do your tax return until you have all your tax documents, right?
Exactly.
And then they correct them too, right?
That's right. Usually could be sometime around mid-March or so.
Yeah. So the tax guy has between February 15th and April 15th to do 500 tax returns. And even if he's going to put them on extension, you still have to do the tax return to some degree to determine what they might owe. Because if they don't pay it by April 15th, then there could even be bigger penalties. So you still have to rough that tax return in, even if you're just extending the tax return. So it's important that you understand the difference between how somebody is doing tax planning on that tax return, not only when you're doing the tax return, but also throughout the course of the year, and somebody who's just preparing a tax return. And there's a big difference between the two.
Right. Well, and one of the things, we're talking about things to do in 2024 for 2023 that, all the time, Drew, we do projections for clients and sort of use the prep as a check your work to see how close we actually, did the things line up the way we thought they were going to line up too.
Yeah.
just another way to plan versus prepare there.
Yep, and we have another sophisticated tax planning software that we can load that tax return into, and it really comes up with some extra insight that maybe the human mind can't see as easily. That artificial intelligence, let's call it, does some extra lifting for us, and that's really cool also.
Yeah, that's great.
All right. Anything else? Any other questions? Anybody have any questions? Here's a question. Can single person contribute to Roth 401k through payroll deduction? Can I also contribute to Roth IRA? Does one impact the other? No. The Roth IRA and the Roth 401k, no correlation whatsoever. So I go to work and I contribute 30,000 to my Roth 401k. It has no bearing on Roth IRA. The only thing that has a bearing on Roth IRA is, was my adjusted gross income under 138,000 or was it over 138,000? Was my married income under 218,000 or was it over 218,000? That's the only thing that impacts the Roth situation, but the Roth IRA situation. The HSA is only impacted on, do I have a high deductible health plan and did I max it out or not? The traditional IRA, though, is dependent on that retirement plan and can vary greatly as to what you can and can't do if there's a X in that box that says retirement plan. Another question, what's the difference between an FSA and an HSA? In case you really want to confuse the issue, there is also an additional HRA. So let's go through the three. FSA is called a flexible spending account. A flexible spending account, I believe the limit is $2,750. And I don't like flexible spending accounts unless I absolutely know that I'm going to have bills. So if I work for an employer that does an FSA and I've got children that are going to put braces on, and I know it's going to cost 3,000, 4,000, 5,000 or whatever it's cost nowadays, I'm going to use the FSA as much as I can to help me lower that cost. But I call the FSA the nanny patrol. In other words, I got to go to the nanny patrol and ask them when I give a $100 doctor bill to give me my $100 back that I put into the FSA. And also I've got to use it or lose it other than $500. The FSA I've got to use before February 28th, or if you're in a leap year like we are this year, you have until February 29th. You have one more day this year to spend your FSA down to $500 or lose it. So, you know, I'm not a big fan of the flexible spending account unless I absolutely know that I've got bills that I'm going to use this thing for. And again, the limit is only $2,750. It's use it or lose it. The HRA is strictly an employer contributed plan that you can use for your medical bill. So the employer puts the money in the plan. It's only there in your plan as long as the employer wants it to be in the plan. And if you ever leave the employer, the HRA money that they put in there is gone. So it's nice that the HRA has the money in there from the employer, not you. But the negative is that if you leave there or the employer decides not to do it anymore, your HRA money is gone. Okay. The HSA is a personal account. It's cumulative and it's yours forever. There's no use it or lose it. There's nobody asking you, who did you spend this on? The only one that will ever ask you on your HSA is the IRS. If they want to challenge you that you didn't use your HSA to pay medical bills, then they can. So far, I've been doing this for at least 13 years, the HSA, and I've never had the IRS challenge a single person yet on their HSA contributions, distributions as to whether or not they were truly for medical bills. So to me, the HSA, and keep in mind also the HSA for a single person over 55 years of age is $4,850. For a married person, it's $8,750 plus another $1,000 for the spouse. So it's $9,750 as opposed to that $2,700 limit for an FSA. I call the nanny patrol. Remember the FSA? So you don't want to. Yeah, I
It's an
don't.
easy way to remember it.
The nanny patrol,
Yep.
tell me I got $100 bill here. I want to get reimbursed for if you'll give me my money back. I don't need that. But if I have a big bill that I know I'm going to pay, like braces for my kids, or I'm going to have a child the next year, and I know there's going to be a couple $1,000s, or I'm going to get my knee replaced or something. FSA, I could see using that if that's the only option I have. Anyway, any other questions, Leo?
I think we hit them all.
I do, unless somebody else comes in real quick. I think we're going to wrap this one up. Sorry about all that confusion at the beginning, but things happen. Technology, it's wonderful when it works, right, Leo?
That's right. But we it's all about adapting, right? So we figured it out and we kept chugging along.
Yeah, and look, when I came back on, you weren't even sweating. I was expecting you to have, towels wiping away the perspiration because but that's how cool hand Luke you are there, Leo.
You know what they say, never let them see you sweat, right?
Good point. All right, I gotta run. You take care, buddy.
You got it. Thanks for joining, everybody. We appreciate it.
Thank you.